हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है बिजनेस कॉम्बिनेशन, दैट इज इंडियन अकाउंटिंग स्टैंडर्ड 103। इन इंडियन गैप देयर इज amalgamation standard, that is AS 14, which talks about only the amalgamation, but in Indian accounting standard 103, it talks about the business combination in various ways, like in the ways of merger acquisition, when one entity merge with another entity. Then asset acquisition is also, it is not a business combination. It is asset acquisition is another concept which we will discuss, but business combination is a combination of one or more business. So today we are going to discuss this topic. So let's start our topic. Agenda of this standard. So the content which we are going to discuss in this standard is, firstly we will discuss about the definition of the business, then definition of business combination, definition of asset acquisition, because business combination is different than asset acquisition. Asset acquisition is that you acquire only the single asset of the organization. If 90%, there is some criteria is there, we will discuss that. If the company, if the entity acquiring only the asset, single asset of the organization, and there is no such income generating from that asset, then it is the only an asset acquisition. It is not a business combination. But if the entity acquire the whole business of the organization, then it is treated as a business combination. Like if the entity acquires along with the asset the running business of the organization, business who is generating the income from that asset, then it is treated as a business combination. And there are some condition which we are going to discuss in the later part. So then the different methods of accounting of business combination, then difference between business combination and asset acquisition, what are the difference we will going to discuss. Then what are the methods of acquisition, like there is a purchase method or common control method of accounting. So there are two methods of acquisition, like purchase method or acquisition method of accounting, or the common control method of accounting. We will also discuss that. So let's start along with some examples. So let's start our topic. Business combination concept is explained with the help of example. So A Limited acquired B Limited by purchase method of acquisition at rupees 100 crores. The means A Limited acquired B Limited by purchase acquisition method. There is two method, like controlling method and purchase method of acquisition. So A Limited acquired B Limited by purchase method of acquisition at rupees 100 crores. The net worth of B Limited is 80 crores. So how we will make an accounting? Because A Limited is going to pay 100 crores to B Limited in order to acquire B Limited by purchase acquisition method. And in the net asset, we will determine what net asset in the books of B Limited is there. Like they have a trade receivable, they have a fixed asset, they have a current asset, they have any other assets along with the liability and loan. So they will take all the assets, reduce the liability. The amount which they are getting is 80 crores. The net worth acquired of B Limited is 80 crores. That purchase consideration, what the A is paying, and the net worth of the B Limited acquired, because they are paying more to the B Limited whatever they are getting. So the differential amount is treated as a goodwill. They pay extra for the goodwill of B Limited, because they are paying 100 crores and they acquire net asset of B Limited of 80 crores. So whatever the differential amount they are going to pay is for the goodwill of B Limited. So that is a 20 crores. Here the A Limited is going to pay 100 crores and receiving an asset of 80 crores. So they are paying extra of 20 crores. So that 20 crores is treated as a goodwill. If they are paying less, suppose they are paying 70 crores and they are acquiring the asset of 80 crores, then that differential is treated as a capital reserve. That is not treated as goodwill. That the differential amount, because they are acquiring more asset and they are paying less in the form of purchase consideration. So the differential amount is treated as a capital reserve. Now another example is A Limited acquire B Limited by purchase acquisition method of rupees 100 crore. The net worth of B Limited is 130 crore. The same way whatever I had taught that if they are paying less, A Limited is paying less, that is 100 crores, but they are acquiring more, that is 130 crores of the net assets of the B Limited. Then the differential amount, because they acquire more, that amount is to be treated as capital reserve. That is not goodwill, that is a capital reserve, because they are receiving more and they are paying less. So that differential amount is treated as a capital reserve. In India's capital reserve is called as a bargain purchase gain, because in India's in accounting standard AS 14, that is amalgamation, we call it as a capital reserve. But in India's that capital reserve is called as a bargain purchase gain. That is a bargain purchase gain and to be recognized in the reserve and surplus. In India's capital reserve is called as a bargain purchase gain and it is to be recognized in reserve and surplus. So now the scenario 1 was of business combination. Scenario 1 of business combination, we will discuss the different scenarios of business combination. Like there is a combination, what are the combination, we call it as business combination. Like in scenario 1, the acquisition of one or more business. If an entity acquire one or more business of an organization, then that is to be treated as a business combination. Suppose for example, suppose A Limited acquire one or more business of B Limited for rupees 100 crores. A Limited acquire one or more business of B Limited for rupees 100 crores. If A Limited acquire एक या एक से ज्यादा business of B Limited. B Limited is a one separate legal entity. And he has the B Limited is having a subsidiary of S1, having a four subsidiary like S1, S2, S3 and S4. S1 is as real estate business, S2 is treated as they are doing the trading business, S3 is service provider and S4 is a mining business. And A Limited acquired the S1 and S4 of B Limited. So A Limited acquire one or more business of a separate legal entity, that is B Limited is a one separate legal entity and he has a different subsidiaries. So A Limited does not acquire the whole B Limited, he acquire one or more business of B Limited. Like he acquired the real estate business of B Limited, that is S1. He also acquired the mining business of B Limited, that is S4. So these combination is also called as a business combination. If an entity acquire one or more business of the another entity, then it is also called as a business combination. Now scenario 2, if acquisition of controlling in other company, if an entity having a power to control, if they acquire the controlling power in the another company, then it is also called as a business combination. Like if an entity acquired the controlling power in the another company, then it is also treated as a business combination. Like power to control other company through board of directors. If one entity has a power to control the board of directors of another company, then it is treated as a business combination. Control over the relevant activities of the other company, holding more than 50% stake in other company. If an entity participates in the financial and operating decision making of another company and having a controlling power, then that combination is also called as a business combination, having a potential voting rights. If an entity having a potential voting rights, then it is to be treated as a acquisition of control in other company, and it is also called as a business combination. This is to be explained with the help of example. Suppose A Limited has acquired 80% stake in B Limited for rupees only 80%. 20% is on another party, then that combination is also called as a business combination. Suppose A Limited only acquire 80% and remaining 20% is a non-controlling interest, and it is also called as a business combination. Combination of all these methods matters applied as per Ind AS 1110. This is an indicator of acquiring control, but other factors needs to be evaluated. Along with that, we have to check the other factors. But if the entity is having a control over the board of directors of another company, over the controlling activities of the another company, holding more than 50% stake in another company, participate in financial and operating decision making of another company, having potential rights in another company, then that company is to be treated as a business combination and having a business combination. So this is an indicator of acquiring control, but other factors needs to be evaluated. Now scenario 3, merger or amalgamation of one or more business or entity. Scenario 3, merger or amalgamation of one or more business or entity. If an entity merge or amalgamate with the business, one or more business entities, means if the suppose if two business are there, they are merged together or amalgamate together and form a one entity, then that is also treated as a business combination. If one or two business amalgamate together or merge together and form one separate entity, that is also called as a business combination. Firstly, if one company acquire another company 100%, but they are existing company. If secondly, they have a controlling power. Thirdly, if one company is acquired or merge with another company and form a new company, then that is also called as a business combination. Suppose A Limited is acquiring C Limited at rupees 100 crores from B Limited. B Limited and A Limited are two separate entity, and C Limited is also a legal entity who is a subsidiary of B Limited. Now A Limited acquired the subsidiary of B Limited, that is C Limited, and C Limited now ceased to exist because A Limited and C Limited are merged together and there is no existence of C Limited. So now only A Limited and B Limited exist. A Limited and C Limited merged together in its books, and C Limited are now ceased to exist. So if two entity merge together and form a one entity, and the existence of the another entity, that is the acquiring entity, is ceased to exist, then in that case it is also called as a business combination. It is also treated as a business combination. Now scenario 4, transfer of business or entity between the fellow subsidiary. Transfer of business or entity between the fellow subsidiary, that is group transaction. A fellow subsidiary. A Limited is having a two subsidiary, that is B Limited and C Limited. A Limited acquire 100% of B Limited and C Limited. So they are the fellow subsidiary. B and C are the fellow subsidiaries of A Limited. And D Limited is a subsidiary of C Limited. So in the books of A Limited, it is a D Limited is a step down subsidiary. D Limited is a step down subsidiary of A Limited, and B and C are the fellow subsidiaries. And if one of the fellow subsidiary of A Limited acquire the step down subsidiary of A Limited, that is D Limited, is the subsidiary of C Limited, then in that case, transfer of business or entity between the fellow subsidiary means between the A and B and C, that is the fellow subsidiary of A Limited. If there is a transfer of entity, then that entity is also called as, that transaction is also called as a group transaction and also called as a business combination. Means if there is an acquisition of a subsidiary of a fellow subsidiary by another fellow subsidiary, then that transaction is also treated as a business combination. Revised structure. Now in the revised structure, previously there is a two fellow subsidiary, that is B and C Limited of A Limited, who acquire 100% stake, and D Limited is the step down subsidiary of A Limited and subsidiary of C Limited. Now after acquisition 100% acquisition by B Limited, now the revised structure is there is a two fellow subsidiary of A Limited, that is B Limited and C Limited, and after acquiring D Limited by B Limited, then it becomes a subsidiary of B Limited. Now D Limited is no more a subsidiary of C Limited because it is acquired by B Limited. Now D Limited is a subsidiary of B Limited. This is the revised structure after acquisition. Now scenario 5. Merger of subsidiary into parent. If a subsidiary is merged into parent or merger of parent into subsidiary. So this is also a group transaction. Suppose merger of subsidiary into parent. In first scenario, if the subsidiary merge into the parent company. Suppose A Limited hold 100% stake in the B Limited and C Limited. B and C Limited, both the subsidiary, A Limited holds 100% stake. Means 100% stake in B Limited and C Limited. So B and C are the subsidiaries of A Limited because A Limited hold 100% stake in both its subsidiaries, that is B Limited and C Limited. Now in this case, suppose B Limited, one of the subsidiary of A Limited, B Limited merge with A Limited. Now revised structure will be B Limited is totally merged with A Limited. Now these two entities merge into a one separate entity and now B Limited cease to exist. Now after merging, there is a revised structure will be A Limited now having a only one subsidiary, that is C Limited, who now there is only A Limited and its subsidiary C Limited exist because B Limited get merged with A Limited. If in case parent merge with subsidiary merge with parent, and if parent merge into a subsidiary, if another case is if the parent merge into subsidiary, in that case suppose A Limited is the holding company, the parent company, who is having two subsidiaries, that is B Limited and C Limited, having an acquisition of 100% stake in B Limited and C Limited. Now in this case, suppose A Limited get merged with B Limited. Now the parent company get merged with B Limited. In this case, suppose A Limited get merged with, in previous case B Limited get merged with A Limited. Now parent company get merged with the subsidiary. Now the revised structure is A Limited is ceased to exist. Now the two entities is there, that is the B Limited and C Limited. Business combination is a transaction where acquirer, those who acquirer obtain control over the business or entity of the acquiree. Now the definition of control as per standard 103. Control encompasses the three distinct principles. Control encompasses three distinct principles which, if present, identify the existence of control by an investors over an investments, hence forming a parent-subsidiary relationship. Means three distinct principles as per the definition of control, because business combination is a transaction where the acquirer obtain control over the business or entity of the acquiree. Means another business ka control, acquire the control. So what is the definition of control? Control is defined as per standard 1010, as per Ind AS 1010. What it talks as per Ind AS 1010, there is a definition of control which is applied equally in this standard also. So what it says that control encompasses three distinct principles, which if present, identify the existence of control by an investor over an investment, hence forming a parent-subsidiary relation. What if power over the investee, exposure or rights to variable returns from its involvements with the investees, and the ability to use its power over the investees to affect the amount of the investor's return. Now, definition of business. Business is what? Business is an integrated set of activities. It is a combined set of activities. It is an integrated set of activities and the assets that are capable or managed for the purpose of. Means business, what is business? Why we will do a business? It is integrated. We will combine the set of activities and assets that are capable or managed for the purpose of providing goods and services. The asset which are in the business, that asset is used to provide the services, goods to investments to earn dividend income or interest income or earn profit or other income in the ordinary course of business. So business is what? It is an integrated set of activities and the assets that are capable or managed for the purpose of providing goods and services, investments to earn dividend income or interest income, or to earn profits or other income in the ordinary course of business. This is the definition of business as per this standard 103. As per this Ind AS 103. Now the elements of business are what? Firstly, we will make an input in the business. We will make a process of that input and the final input output emerged out. So input is there, processes is there, and the final output is there. So that these are the elements of the business. Why the people will do business? They input some activities in the business, they process that activity, and the results came out that in the form of output. So that is the element of business. Firstly, what inputs are there? Like non-current assets like plant. We are inserting plant, license, patent, copyright. These are the examples of inputs. Intellectual property rights, skilled workforce, labor, material rights. These are the inputs which we immersed in the business, and how we will process through management process. These inputs are processed by the management process, by operating process, by resource management process. So then what comes out? That is goods and services. Incomes comes out in the form of dividend, interest, profits comes out from the business. Other incomes comes out after this process. So if we are incurring emerging some input, we make a process on that and the final output comes out in the form of profits. So note, administrative activities like day-to-day accounting, bookkeeping, billing, payroll accounting, etc. is not enough. Like day-to-day accounting, these are not the inputs. These are the bookkeepings, billings, payroll accounting is not an input. So these are not the examples of inputs. Now further assessments of business. If we make a further assessment of business, what the actual, this is the basic. Firstly, this input process output is the basic assessment. Now we will make the further assessment of business, like integrated set of activity. What, as per the definition, business is an integrated set of activity. Now what is integrated set of activity? Integrated set of activity must consist of inputs and substantive process. Now What is substantive process? What is substantive process means which is practically exist or not. We will check that these process is practically exist or not. Integrated set of activity must consist of input plus substantive process. Now, what is substantive process? In scenario 1, when the set of integrated activity does not have output on acquisition date. On the date of acquisition, there is no output exist. In case of scenario 1, suppose where the set of integrated activity does not have the output on acquisition date. Process is substantive if the following conditions exist. Processes, process is capable of generating output. Input consists of workflows which are skilled and knowledgeable, and other inputs like material rights and intellectual property rights. Then this combination is a substantive process. Now the scenario 2, where the set of integrated activities have the output on acquisition date. In this case, the set of integrated activities have the output on the acquisition date. In the previous case, the set of integrated activities does not have output on the acquisition date. So in this case, there is an output on the acquisition date. So the process will continue to generate. If they have output on the acquisition date, this will continue to generate output. And the process is unique. Such process cannot be changed or replaced without incurring significant cost. Concept of asset acquisition. What is the concept of asset acquisition? We had discussed the definition of business combination in various scenarios. There is a different scenarios for business combination. Now, what is an acquisition? Asset acquisition, if a entity acquire a single asset, then it is a case of asset acquisition. Suppose this is to be explained with the help of example. Suppose A Limited acquire B Limited at rupees 100 crores, and in the balance sheet of B Limited there is only land exists. In the balance sheet of B Limited, only the land is there, and the income of that B Limited is revenue is nil. Only interest income is there because cash is there. So they are deposited cash to the bank. So interest income is there, and expenses is normal expenses in order to in order to make admin expenses. So 20,000 is the expenses, and the net income of B Limited is 80,000. So the income is not derived from the asset, that is from land. The land is idle, there is no use of land. So if there is no output generating from the land, and in that case, if the entity acquired, that entity who is not generating any output, only the asset is there in the balance sheet of that unit to whom they are acquiring. So in that case, this is not a business combination. This is a concept of asset acquisition, because they are acquired only a asset of that unit, that organization, not the whole unit, because B Limited does not have any income from the asset. They are not generating any income from the asset. Rather, they don't only have a land which is idle. So they are acquiring. A Limited is acquiring the asset of the purpose of A Limited to acquire B Limited is the acquisition of that land which is held in the balance sheet of B Limited, that is of 90. So in this case, there is an input, that is only land is there in the books of B Limited. Means input in this case is only the land in the books of B Limited. There is no process on the land because no process is there, because they are not generating revenue by using the land. So no process, no labor, there is no output from utilization of the asset of B Limited. And so in this case, no business combination. This is the case of asset acquisition. Because the purpose of A Limited is not to acquire the business of the B Limited, because they don't have business. The purpose of A Limited to acquire B Limited is to acquire the asset which the B Limited is having. So this concept is the concept of asset acquisition, not a business combination. Now concentration test. This test is also called an optional test. This concentration test is not mandatory. This is an optional test. But some organization, in order to, before doing the business combination, they may do this test for their satisfaction. So concentration test is not mandatory as per this standard, but still for their satisfaction they do this testing. If the fair value of the gross asset acquired is substantially equals to the fair value of identifiable assets or group of assets, it is a case of asset acquisition and not a business combination. Now, in order to do the concentration test, what we get to know, we will get to know whether it is a case of business combination or it is a case of asset acquisition. How we will know? Because if an entity acquiring the asset and the gross value of that asset is substantially equals to the fair value of the identifiable or group of assets, it is a case of asset acquisition or not a business combination. The word substantially means largely, which is not defined. Practically, we use 90% or more is means in order to acquire substantially equals to means 90% or more equals to the fair value of identifiable assets or the group of assets. The fair value, how we will determine the fair value of or fair value of the gross asset, how we will find out purchase consideration which the entity is going to pay plus the acquisition of non-control, the fair value of the acquisition of non-control plus the fair value of previously held stake, that is previous investments, plus liability incurred if any, minus cash and cash equivalent received, minus goodwill acquired on account of deferred tax liability. So after this is the formula of determining the fair value of the gross asset. Purchase consideration plus fair value of non-controlling interest plus fair value of previously held stake plus liability incurred minus cash and cash equivalent received minus goodwill acquired on account of deferred tax, and the amount which came out is called as a gross asset acquired or amount payable to acquire the asset. This we are talking about the asset acquisition because 90% or more if the fair value of the asset, if a fair value of the identifiable assets or group of, it is a case of asset acquisition and not a business combination. Because we had discussed business combination where the input is there, where process is there and the output generator. But in order to determine whether it's a case of asset acquisition, we have to do the concentration. But firstly, we will discuss how what is concentration test. Firstly, we will determine the gross fair value of the gross asset. Fair value of the gross asset. Then we will find out the percentage of stake of gross asset in respect of identifiable assets or gross assets. Means assets or a group of assets divided by gross assets into 100%. So if this is 90% or more, means assets or group of assets, whatever assets or group of assets lying in the books divided by whatever we compute in step 2, that is gross assets into 100%, if that amount is that percentage is 90% or more, it is a case of asset acquisition and not a business combination. Practically, we consider 90% or more, but in some cases, judgment is also required. Practically, 90% or more is a case of asset acquisition, but in some cases, judgment of management is also required. Judgmental is also there. In some case, we will take decision on the basis of judgment. Now, this is to be explained with the help of example. Suppose illustration. Company A is a pharmaceutical company since inception. The company has been conducting in-house research and development activities through its skilled workforce and recently obtained an intellectual property rights in form of patents over certain drugs. The company has a production plan that has recently obtained regulatory approvals. However, the company has not earned any revenue so far and does not have any customer contracts for sale of company B acquire company. Now, in this case, what happened? Company A is a pharmaceutical company. Since its inception, since the day of inception, company is doing a pharmaceutical business. The company has been conducting in-house research and development activities through its skilled workforce and recently obtained an IPR in the form of patent and over certain drugs. So they are doing their own in-house research and development they with their own workforce, and they also obtained IPR in the form of patents on certain drugs which they are manufacturing. The company has a production plant that has recently obtained regulatory approvals. The company's production plant has recently obtained regulatory approvals for the manufacturing of the medicines. However, the company has not earned any revenue so far and does not have any customer contract for sale. They had they had acquired the approval, they have intellectual property rights, they have skilled workforce, they have also in-house research and development, but still they are not earning any revenue right now, and they don't have any customer contract forces. So in this case, if company B acquire company A, does company A constitute a business in accordance with Ind AS 103? In this case, if the company B, any other entity, acquired this entity, then this is a case of business combination or it is a case of asset acquisition. As per Ind AS 103, we have to determine that. So, company B Limited acquire company A Limited. A Limited is a pharma company who is having a research and development, that is the input. Skill workforce is also the input of the organization. IPR is also the input. Production plant is also the input. Regulatory approval is also the input. No customer contract and management process. Management process is also there. This is the process, and no customer contract and no output. So in this case, whether this is a case of business combination or asset acquisition. The definition of business requires existence of inputs and processes. In this case, the skilled workforce, manufacturing plant and IPR along with strategic and operational process constitute the inputs and process in line with the requirements of Ind AS. The entity A is having input and process also. As per the definition of business, what it requires the existence of inputs and processes. In our example, both inputs and processes is there. Still, even though they are not generating the output, still it constitutes the definition of business as per the requirement of Ind AS 103. So, when the said input and processes are applied as an integrated set, the company A will be capable of producing output. The fact that the company A currently does not have revenue is not relevant to the analysis of the definition of business under Ind AS 103. Currently, they are not incurring any revenue, but they have a capability to produce the output because they have an input and process is also present as per the definition of business. Currently, they are not generating the revenue, but they have a capability of generating the revenue. So, the revenue is not relevant to the analysis of the definition of business under Ind AS 103. So, it does not, if they are not generating revenue, it does not constitute that they are not earning an income. They don't have business because their basic criteria of business, that is the input and process, are present. Basis this and presuming that the company A would have been able to obtain access to the customers that will purchase the because the company A has the ability to obtain access over the customer that will purchase the output, and in purchase the output, the present case can be said to be constitute a business as per Ind AS 103. So it can be said that they have a capability to generate revenue to make a customer. So they are fulfilling the definition of business as per Ind AS. Now illustration 2. Continuing with the previous example, in the previous example, company A is having a business because they have having a input and process, and thus they are fulfilling the definition of business as per the Ind AS 103. So this is a business. Just we are modifying the above example. If company A have revenue contract also and sales falls also, these two are also present, then such company B, then that company B acquire all inputs and process other than the sales force, then whether the definition of business is met in accordance with Ind AS 103. In this case, it was saying that company A is also having a revenue contract and sales force, but company B acquire all inputs and process other than the sales force of A Limited, because company B itself is having their own sales force. So they are not acquiring the sales force of A Limited. In that case also, whether they are fulfilling the definition of Ind AS 103 of the definition of business as per Ind AS 103. Though the sales force has not been taken over, however, if the missing inputs, that is sales force, can be easily replicated or obtained by the market participants to generate output, it may be concluded that the company A has acquired business. Further, if the company B is also into the similar line of business, then existing sales force of a company B may also be relevant to mitigate the missing inputs. As such, the definition of business is met in accordance with Ind AS 103. It was said that, it was saying that, like company A is having their sales force and revenue contract and other inputs as we had discussed. But company B, while acquiring company A, they had not acquired the sales force of A company A Limited, and they had acquired all the inputs of A Limited other than the sales force of A Limited. Why? In that case, they are fulfilling the definition of business as per Ind AS 103. It was said that yes, they are fulfilling the definition of business. How? Because they are, if we are taking that, suppose the company B has not taken the sales force of A Limited, two cases are there. One case is that if the company B is having their own sales force because they are in the same line of business, the company B is having their own sales force, so they are not taking the company A's sales force. They are not taking that in because their own sales force is relevant to mitigate the missing inputs. And another option is this. Suppose if the company B is does not taking the sales force of A Limited, so they are These sell force they are obtaining from the market in order to generate the output. They are taking the sell force from the market and they will generate their output. So in the two way they can generate the output. It is not necessary that they are relevant to take the sell force if they have the same line of sell force in their organization. So it does not say that they are not fulfilling the definition of business as per Ind AS. Now illustration 3, concentration test. In this illustration we will test the concentration. We will apply the concentration test. So entity A holds 20% interest in entity B. Suppose entity A is holding 20% interest, not the 100%, 20% interest in entity B. Subsequently, after 1 year, entity A further acquire 50%. Now it becomes 70%. Previously, entity A is having 20%. After 1 year, they acquire further 50% in the B Limited by paying rupees 300 crores. Now they have a controlling over the entity B, because controlling stake, like more than 50% is the controlling stake. So A Limited is become a controlling in entity B. Now the fair value of the asset acquired and liability assumed are as follow. Building is 1,000 crores, cash and cash equivalent is 200 crores, financial liability is 800 crores, and deferred tax liability is 150. These are the assets and liabilities in the books of B Limited, to whom the A Limited acquired. Now the fair value of entity B is 400 crores and fair value of non-controlling interest is 120 crores. Now fair value of entity A, previously held interest, like they are having an interest of 80 crores which they are having previously, like 20% of the interest in entity B, entity A holds previously before acquisition of 50% stake in B Limited. So the fair value of entity A previously held interest is 80 crores. Now entity A needs to determine whether this acquisition is asset acquisition as per concentration test. We have to determine whether this acquisition is an asset acquisition or a business combination by using a concentration test. Because what concentration test says, 90% or more of the gross assets. If the 90% or more of the gross assets or liabilities, case of asset acquisition. So we will determine that. Solution: before acquisition, entity A holds 20% stake in B Limited. After acquisition, entity A further acquires 50% stake in B Limited by paying rupees 300 crores. Now the assets and liabilities in the books of B Limited at the time of acquisition. That is building 1,000 crores, cash and cash equivalent 200 crores. So total becomes 1,200 crores minus financial liability minus deferred tax liability. It becomes net asset acquired is 250 crores. 1,200 minus 950, it becomes 250 crores. Now the fair value of the entity B. Fair value of the entity B is 400 crores and fair value of non-controlling interest is 120 crores. Now computation of gross assets. Purchase consideration, the entity A is paying in order to acquire 50% of the stake in B Limited by paying 300 crores. So purchase consideration is 300 crores. Non-controlling interest is 120 crores as mentioned in the question. So the fair value of that stake is 80 crores. So 300 plus 120 plus 80, it becomes 500 crores. Cash received. Cash and cash equivalent is 200 crores and the fair value of liability assumed excluding deferred tax is 800 crores. And no, in these case, this is the assets having in the books net asset acquired, and this is the gross assets, computation of gross assets. So, no, gross assets means amount paid or payable to acquire identifiable assets or group of assets. Now, in this case, what are the identifiable assets? The identifiable asset is only the building of 1,000 crores. There is no such other assets in order to generate the output in this case, because only building is there, and the motto and the purpose of the entity A in order to acquire B is the acquisition of that building only, because there is no such other assets who are generating the income. So the gross asset, that is amount paid or payable to acquire, that is 1100 crores. Now we will determine the percentage assets or group of assets, that is 1,000 crores, the building, the value of the building, and the gross asset which is defined, which we will determine in step 1, that is 1100 crores. So 1,000 divided by 1100 into 100, it becomes 91%. So this percentage is more than 90%. So this 90% is substantially concentrated to the fair value of the building. Therefore, such acquisition is an asset acquisition and not a business combination, because the gross assets or group of assets which the entity acquired is more than 90% for the amount which is paid. Means amount is paid is more than 90% of the value of the asset acquired, because in this case the amount paid is 1100 crores and the asset acquired is 1000 crores. Then in that case, this is a case of asset acquisition and not a business combination. So this is the theory which we are going to discuss, theory of asset acquisition. Asset acquisition means acquiring an identifiable asset or a group of asset. In this case, the identifiable asset is the building only, because no other assets is there, only cash is there. No other assets, and they are not generating any income. Asset acquisition is not a business combination. If asset acquisition is there, it is not a case of business combination. In asset acquisition, no goodwill, bargain purchase gain is there to be recognized in case of asset acquisition. Transaction cost, if present, then it should be capitalized in the value of the asset in case of asset acquisition. What is transaction cost? Any incremental cost. It should be capitalized to the value of the asset. Example of incremental cost are brokerage, commission, stamp duty, registration fee, legal cost. These are the incremental cost which should be capitalized with the value of the asset. Now, so we will discuss the difference between the business combination as a asset acquisition. The difference is there. There are some differences, like one difference is there, goodwill or bargain purchase consideration. In business combination, we will recognize the goodwill or bargain purchase consideration. But in asset acquisition, goodwill or bargain purchase consideration means capital reserve. We will not recognize that. Transaction cost. In case of business combination, transaction cost shall be charged to profit and loss account. In case of business combination, if it is a case of business combination, transaction cost is directly charged to PL account. But in case of asset acquisition, it should be capitalized with the value of the asset. Transaction cost should be capitalized with the value of the asset. Contingent consideration. If the contingent consideration is taken in case of business combination, it should be considered at fair value of the, for computation of the before, because in amalgamation we are not taking the contingent consideration, but in business combination it should be taken at fair value and should be taken in the computation for computing the goodwill, should be considered in the computation for considering the, for determining the goodwill. And in asset acquisition, contingent consideration is not taken, not to be considered. Now, what is contingent consideration? It means it will be, we had discussed the contingent consideration, that is, it depends on the occurrence or non-occurrence of the future events. So, what value we will take into consideration, like legal case, if there is excise suit case, is there some pending assessments are there. So that contingent consideration is to be taken at fair value in order to determine the goodwill. Additionally, amount payable on achievements of some condition in futures. So the example of contingent consideration, sale will reach to 2% after 3 years. EBITDA will reach to 1.5% after 5 years. Acquirer will able to obtain license in the next 6 months. They have a pending license. So that contingent consideration is taken into consideration while determining the value of goodwill, while computing the value of goodwill. Now, measurements of assets and liabilities, initial recognition. Initially, how we will measure the assets and liabilities? In business combination, it should be measured at fair value, and in asset acquisition, allocated allocate cost on the basis of the fair value. Allocation of cost on the basis of fair value. Now, applicable standard for business combination, there is a standard called Ind AS 103, and for asset acquisition, Ind AS 16 is to be followed. Hidden intangibles to be identified and recognized. If any hidden intangibles are there in the business combination while acquiring the assets and liabilities of other entity, if any identifiable, any hidden intangibles is there, it should be identified what hidden intangibles are there, and then it should be recognized. For example, any internally generated brands is there, any customer list are there, it should be identified firstly and then it should be recognized. And if any hidden intangibles are there in case of asset acquisition, it should not be recognized. Now, deferred tax is there, it should be recognized for business combination, and in case of asset acquisition, it should not be recognized. Now, we will discuss one example. Suppose A Limited acquired B Limited at a purchase consideration of 10 crores, and 2 crores will be the transaction cost. This case is related to the transaction cost. In case of asset acquisition, it should be capitalized, and in case of business combination, it should be charged to profit and loss account. So, in the scenario 1, if the transaction cost is there, in case of business combination, how the treatment is to be done, and in case of asset acquisition, if transaction cost is there, how treatment is to be done. So, balance sheet is there, balance sheet of B Limited, that is, two assets are there, land 1, land 2, and the fair value of that land. Land 1 is 4 crores and land 2 is 4 crores each. And the entity A acquired B Limited at a price of 10 crores, and they also pay 2 crores as a transaction cost. So in case if it is a case of business combination, then the purchase consideration is 10 crores, which the entity A is going to pay to the B Limited in order to acquire B Limited, and less the fair value. Less the fair value of the asset acquired is 8 crores. So differential amount is 2 crores. And the transaction 2 crores is there, which should be charged to profit and loss account. The transaction cost, that is the incremental cost, is to be charged separately in the PL account in case of business combination. It should not be capitalized with the value of the asset. Now we will make the journal entries. Firstly, in case of business combination, like net asset account डेबिट 8 crores का एसेट उन्होंने लिया, गुडविल लिया 2 crores का, to purchase consideration they had paid 10 crores at the time of being asset acquired. But at the time of discharge of purchase consideration, purchase consideration account debit to cash or equity. In the form of cash they had paid or in the form of shares. And the transaction cost is to be charged to P&L account. So transaction cost account debit to bank by 2 crores at the time of making the payment. Now the scenario 2 is this treatment of transaction cost in case of asset acquisition. Now how the treatment is to be done in case of asset acquisition. Treatment of transaction cost. Now the total amount paid is purchase consideration is 10 crores plus we will add the transaction cost in case of asset acquisition. In case of business combination, it should be separately charged to profit and loss account. It should not be capitalized. But in case of asset acquisition, it should be added with the purchase consideration. So total consideration is 12 crores. Now allocation of total consideration in the value of the asset. Now the fair value of the asset is land 1, land 2, 4 crores and 4 crores. Consideration paid. How much consideration they are going to pay. It should be allocated to the value of the assets. So total consideration they are paying of 12 crores and it should be allocated to the value of assets. So 4 crores divided by total 8 crores into 12 crores. So it becomes 6 crores and 6 crores each. Allocated cost on the basis of the fair value. Key points in asset acquisition. No goodwill, bargain purchase gain is there. Transaction cost is to be capitalized. No deferred tax. Consideration is allocated to the asset. Now, in today's discussion, we had discussed these concepts. In the next video, we will continue our remaining concepts. Thanking you for watching my video. Please like, share, subscribe my channel.